Good evening and welcome to ET Now. I'm Ashwin Mohan and you've tuned in to our special show GST and You, which is part of ET Now's in-depth ongoing coverage of the implications of India's biggest and most ambitious tax reform, the GST, which is all set to roll out from the 1st of July this year. At the 14th meeting of the GST Council held recently in Srinagar, the rate structure on a majority of the goods and services was approved. A total of 7 set of rules on aspects ranging from registration to refunds got the nod of the Council. And rules relating to returns and transition are being finalized. So before the next meeting of the GST Council on 3rd June 2017, over the course of the next half an hour, we are going to take a closer look at the impact of the new regime on you, the consumer, as well as you, the trader. We will be taking live queries as well from our viewers, and joining me to answer them are two indirect tax experts, Dr. Shrikant Kamat, partner at BDO India, and Uday Pimprikar, partner at EY. Gentlemen, thank you so much for taking out time and joining me on this GST special. Uday, let's kickstart the show by taking a closer look at the tax rate on goods and some of the important commodities which fall under each of these tax rates. Let's take a quick look at them. Now, the nil rate category covers 7% of the total commodities. This includes milk and food grains. We next have the 5% category, which covers 14% of the total commodities. This includes coal, sugar, tea, and coffee. The 12% category covers 17%. And then we have the 18% category, which covers the highest number of commodities, which is 43%. And finally, we have the 28% category, which covers 19% of the total commodities. And this includes motor cars and consumer durables. Preliminary comments are there. What do you make of the rate structure? And also, is it on expected lines when it comes to striking that much needed balance?
See, I mean, the Revenue Secretary, in each of the interactions that he has been having for the last couple of months, has always suggested that this is more of a mathematical exercise, okay, and they have done research, and whatever is the effective tax that's applicable on a particular commodity, they have just replaced that with the new GST with in the nearest tax bracket. So for them, it was a mathematical exercise. Conceptually, therefore, a lot of categories like the products which are in 18%, they have kind of gone ahead and suggested that whichever products which were around 16 to 22% will go into 18%, and so on and so forth. That's how they've gone about.
But do you think it strikes the balance that the industry was expecting and the trading community was expecting?
So, I mean, this entire issue about whether the categorization of the products have been appropriate is always going to be debatable.
All right.
It is a translation, if you ask me, of the entire history of tax policy in this particular buckets that they have.
So it's not an easy answer.
It's not.
Dr. Shrikant, your initial comments. What do you make of the manner in which the tax slabs have been categorized so far? A majority of the tax slabs on goods and services have now been announced. Your initial feedback, especially from the trading community and some of your clients.
I think the government as well as the GST Council has tried to be as transparent as possible in terms of how they are going to work out the tax rates. So apparently there are very few surprises or shocks, if we can call that. And we should really appreciate that the council and the government have done a commendable job, a phenomenal job, because the challenges were multifold at various levels. The structural level, we have a federal system of taxation, so you have to also consider the expectations of the states, so as well as the industry expectations, and then ensure that everything fuses in very seamlessly. You
know, there are so many stakeholders that you can't really keep everyone happy. There will be a few hits and misses.
Absolutely.
In fact, on that note, Dr. Shrikant, I also want to pose to you a question on how does this fare when it comes to the GST regime in overseas jurisdictions? Clearly, there are many benefits. This public announcement of the tax rates on goods and services will help in shaping our business processes. They will also help in assessing the financial impact as well as the pricing strategy. But how does India's current existing regime compare to that existing in other overseas jurisdictions?
See, I think if you just look at the tax rates, probably you will see them quite high over here. For most, even a 18% rate apparently is seen to be quite a high rate as compared to other jurisdictions, especially in the European Union and other developed countries.
Uday, would you concur with that? That the tax rate is more or less higher if you compare it to some other overseas jurisdictions?
Absolutely. Absolutely. I think 18 and 28%, okay, are very high rates. In fact, you have taxes which go up on some of the products which as high as 43 and 44%. There are other elements, and this is not an easy decision to make, even for the government. If you have high rates such as 28 and 43%, there's a huge incentive to go ahead and evade tax. You know, there's a huge disincentive to actually go ahead and even comply. So the moment you have these high rates, it will mandate the government to have a fairly strict reporting mechanism, which they are trying to attempt. And I mean, to that extent, our overall tax regime is fairly different than the general tax regimes that you otherwise see.
I can imagine. Hold on to your thoughts, Uday, because we now have our first live caller, V. Suvarna from Mumbai. Go ahead. What's your query?
Hello.
Yes, go ahead. You had a query on plywoods. Can you please go ahead, and our guests are waiting by to answer your query.
28%, and yeah, my question is the plywood is taxed on 28%. Yes, and your laminates. You should understand that plywood is complementary, and without the plywood, you cannot use your laminates. You cannot use. That is the most important thing. So it has to be either 18% flat. It cannot be two different variants. You see, it cannot be.
All right. We've got the gist of that question. Dr. Shrikant, I'll pose that to you. The viewer is essentially saying, why is there a variable tax rate structure for plywoods as well as laminates? Why is there not a flat rate? In fact, that's the case in many other segments as well. So what do you have to answer to our guest?
See, I would like to believe that the government has very transparent data to support whatever classification and the rates that they have allocated to specific items. So I'm sure basically the intention is to not only be at par or even better in terms of the tax efficiencies or the efficiencies in terms of the entire credit mechanism and all of that, but also to ensure that if we have a lower rate on laminates and a higher rate on, in fact, in that industry, I believe there is a very high level of value addition, and somewhere the high level of value addition will probably ensure that I mean, some kind of a balance would eventually happen. So somewhere we have to trust the government that they have a tangible and transparent data.
Of course, they've done the research, and
Absolutely.
somewhere they have to take tough decisions.
Yeah. But at the same time, it may not necessarily be so accurate and precise for each and every commodity. So there could be a few hits and misses.
Sure. All right. So that's the initial feedback on our first query. There will invariably be a few hits and misses, and the government, of course, would hope that the consumers as well as the traders have their faith as far as the government's rationale is concerned. On that note, Uday, let me also speak about the fact that there was earlier a belief that only a few of the luxury goods like aerated beverages would be taxed under the highest tax slab of 28%. So then does a longer list, which we now know coming under the higher tax rate, come as a negative surprise of sorts?
See, if you go and look at this this particular list, which is at which is including the composition cess and the effective tax rate goes up, it really includes. I mean, the total line items, I think some 55 line items, but a large part of it is actually in the existing categories of products that they had initially suggested. Okay. Having said that, there is nothing under the law which restricts them right now to go ahead and only impose on certain kinds of products.
Sure.
And therefore, they can very much go ahead and expand that list. Again, the way they have gone about it is to looking at their existing tax rates for these products and trying to kind of map that in the new, and if there is a requirement, then imposing a cess. But it's possible that they will go ahead and increase that list. Whether they should, to my mind, of course not. I mean, a 43 or a 40% rate, again, is a very high rate. Okay, and it needs to be. But I mean, they have imposed it on tobacco and stuff. which is fine, I guess.
You know, we've got a next caller on the show, and that's Chandramohan Rao. Chandramohan, calling in from Hyderabad. We have Uday Pimprikar, our tax expert, standing by. Go ahead, sir. What's your query?
Yes. Hello.
Yes, Chandramohan, go ahead.
Can you hear me?
Yes, I can hear you clearly. Go ahead, sir.
Yeah, very good. Good evening. Very good evening. This is
Good evening.
Chandramohan here. This is regarding the advertising agencies. How is it covered?
What about advertising agencies, Uday? That's a niche industry, media and entertainment. How has the GST Council looked at the taxation of that industry?
See, the agency has a very different kind of treatment even today. Okay, the agency services. Agency services today, the way it pans out is that you will be liable to tax. The agency is liable to tax on its commission, and then it's liable at 15%. And the advertiser takes a credit on the media invoice directly. Okay, that's how it happens for media kind of charges. For creative, it is whatever the services are liable at 15%. In the newer setup, what mostly the agency industries are, the agencies are going to do, or the media vis-a-vis agency and the advertiser are likely to do, is that the media is going to charge the advertising agency.
Sure.
Okay, and the agency would in turn charge, and agency would be considered to be a recipient or the customer for the media, and agency would in a sense be charging to the advertiser, and the rate of tax to be charged by the agency related to media planning activity or media kind of recharges is that the media for broadcasting and television media, digital media, all of that is at 18%, and print is at 5%.
Sure.
So these are the two rates that the agencies are likely
Have to keep in mind.
Yeah.
All right. Hope that answers your query, Chandramohan Rao. In fact, we've got a flurry of calls coming in on GST and you. We now have a caller coming in from Jalandhar, Gurpreet Singh. Gurpreet, go ahead. Welcome to the show. What's your query?
Hello. Hello.
Yes, Gurpreet, go ahead. What's your query? Welcome to the show.
Here I just want to know that it is mandatory to maintain stock under GST.
All right. Is it mandatory to maintain stock under GST? Dr. Shrikant Kamat, why don't you come in over there?
Yeah, apparently the whole compliance structure in GST is completely built on disclosures, and disclosure of stock is also mandatory, in the sense that somewhere it has to match with the kind of credit that you are reporting in your ledger. So to that extent, you cannot look at stock on a standalone basis. You will have to really map it with the kind of credit that you are going to avail.
And one also needs to keep in mind that the transition rules are yet to be notified, and that could have an impact on the stocking and the destocking of goods, Dr. Shrikant?
No, there is a fair visibility on the transition rules, and right now the industry is well aware of what they can take into the new regime and to what extent. So somewhere apparently since there is a visibility, so you can very well plan in advance in terms of how you are going to, what is the kind of inventory you are going to hold going into GST, and on the appointed day, how much would you want to stock and which location. So all that planning can be done now. Right.
All right. So there's a fair bit of visibility on that aspect as far as stocking of goods is concerned.
Right.
I hope that answers your query, Gurpreet. Now we also have a caller coming in from Chennai, Mahindran. Go ahead, sir. What's your query to our expert panel?
Yes, my name is Mahendran and I'm calling from Chennai. Very happy evening to you all.
Thank you and welcome to the show. Please go ahead with your query, sir.
All right. See, I represent the construction industry.
Yes.
And in construction industry, the cement is the most vital factor in the entire construction industry. The earlier slab for cement was the excise duty of 12.5% and that of 5% in Tamil Nadu, which means a total of about 70.8% around. But now what has happened is we are now paying 28%. Under the new GST, we are required to pay 28%. But a widely used commodity, the price has to come down, which means we were expecting a slab of about 12% or even 5% on that range. So could you explain how a factor of which was only under 18% has been gone up to 28%?
Sure. All right. So he represents the construction business. He's talking about the fact that the slab on cement is way more higher than what perhaps him and his community expected. Uday, would you like to help him understand the rationale behind this jump from the expected 18% slab to 28%?
This question actually has been asked to the Revenue Secretary several times, and I think I can understand the anxiety and I actually empathize. What the government is saying on their decision to categorize cement under 28%, rightly or wrongly, is that they looked at, while there could be certain states where the rate of tax was actually muted on cement, there were several other states where the VAT rate was much higher, and at the residue rate of 12 or 14%. And on an average, when they saw this overall kind of rate, the effective tax on a pan-India basis was actually higher, around 24 to 25 or 26%. And given that 28% was the nearest peg that they could have pegged it, they've gone ahead and allowed that to be at 28%. On the flip side, what they're saying is that they are allowing credit of that part of that that entire tax to the extent that it is used for construction, and then the output is liable to charging to GST. So to that extent, given that it is, from their perspective, it is to some extent a B2B supply, at 28% should be okay. Whether it is right or wrong, again, to my mind, is fairly debatable, but that's their perspective.
All right. So that's Uday simplifying the rationale behind the higher tax rate slab as far as cement is concerned and the impact on the construction business. We also have another caller, Sagar from Mumbai. Sagar, I'll have to request you to hold on for a bit because, Dr. Kamat, I now want to move on to services as well. We have spoken a lot about goods. If you look at services, the GST Council has decided to tax services in all the tax rate slabs as is in the case of goods, right? This includes 83 services which will be exempt, including health and education, and 13 services including traveling by road and air in economy class will attract 5% tax. Now, Dr. Kamat, the exemptions and the lower tax rate for certain essential categories should definitely should provide some cheer to the masses, right?
Yeah, I think the government has gone by the exemptions which are currently in existence right now under the service tax regime. So they have not tried to tinker with that too much. So maybe a couple of exemptions they have tried to take away, but otherwise most of the exemptions have been retained. So apparently the industry really would not have any kind of complaints on that front. Maybe a few exemptions which were expected have not really been announced. Maybe we can still wait and watch how things would go. But I think fairly the landscape on services is on expected lines. And I think it is really commendable that most of the transport related services have been classified under the lower tax rate. So that is going to bring big cheer for the transport industry as well as all the other businesses which are really affected by it.
All right, I have another question on services, but I'll hold on to that because we have Sagar on the phone line. Sagar from Mumbai, go ahead. What's your query on GST?
Hello, sir. Good evening. My question relates to the taxation of branches of foreign companies. So under the service tax regime, when a foreign company's branch rendered services to his overseas parent, it was not liable for service tax. But now under the GST regime, will it be liable to GST under the IGST law? Because there is no specific exemption.
Very interesting question, Sagar. Uday, would you like to take that?
Effectively, the law related to taxing of a foreign branch or an Indian branch providing services to a foreign head office or otherwise, technically there has not been too much of a change on the taxability. There is some amount of issue related to place of supply still, but whether taxability of that has not undergone too much of change. Okay, and so in the existing, while I am not opining whether it's liable to tax or not, in the existing law, if the nature of service is such that it wasn't taxable, one could think that the present services may not be taxable. The problem actually on the new law is only the relation to the valuation. Okay, Earlier, there was no concept of valuing a service when it was provided to a related party or not. It was actually transaction value that we went up with. Now with that change, every nature of service that is being provided inter, say, a branch outside and within India, and so on and so forth, would need to be valued at arm's length.
Sure.
Okay, and that I think may create a bit of an issue.
Uday, I'm going to ask you to hold on because I quickly want Dr. Shrikant's input on this specific question as well, which has come in from Sagar from Mumbai. Dr. Shrikant, go ahead.
So, what I understand, the question is whether is there some visibility on how, in fact, transactions between the overseas entity and the Indian entity would, related parties would really, how that would map out in GST. So I believe, as he has rightly pointed out, the landscape won't be any different. Probably the only challenge would be how the valuation of the services would be, demonstrated in terms of that it is completely transparent. So somewhere, if you can manage that, then I don't see any new challenges in the GST regime as well.
So, but Sagar has a point. Okay, with this change in the valuation norm, I think individual services would need to be still looked at. Earlier, it could have still gotten away with not charging and so on and so forth. Now, I think you will need to look at it.
So, probably that's something that the government needs to reconsider.
Yeah.
We have a live caller from Belgaum, but before I move on to him, Uday, even though because of the GST design and its efficiencies, it will lower the effective tax rate. But many believe that the overall rate for services is still higher than expected in some crucial segments, like say, for example, telecom, a few others like luxury hotels and cinema halls. How has the industry responded to these high rates?
Okay, I think these industries have gotten a bit of a short shrift. Okay, and I think the government clearly needs to reconsider this. And let's take each one of the stuff of the 2-3 sectors that you kind of mentioned. On the telecom, the existing tax rate was 15%. That has gone up to 18%. And I think that was done on account of an understanding that the government has that the incremental credits that they have or the incremental reduction in the cascading tax for a telecom industry would kind of be good enough to take care of the increases in 3% tax. The facts are slightly different. The fact actually is for established telecom services.
So as we speak today, Uday, is there a strong case for the government to relook at the tax rate related to telecom?
Absolutely. For several accounts. One is that telecom is a necessity. It's no longer luxury.
Sure.
And the fact is that the actual benefit on cascading tax is not more than 0.5 to 1%. For larger telecom companies, and so to that extent, there is a clear need for the government to reconsider.
All right.
So that is one. The second, I wanted to just cover about cinema. Cinema has gone to 28%. Actually, that again has been under a misconceived notion that the existing tax rates were really very high at entertainment tax. So existing for cinema was that there was no tax applicable till the retail end of exhibition, and exhibition was liable to an entertainment tax. Now what has happened is that, and so basically there was an exemption entertainment tax applicable. The average entertainment tax, if you look at on a pan-India basis, on the entire box office is not more than 8-9%. Now, so therefore the effective tax on cinema tickets was actually 8-9%.
Which is not as high as was widely perceived to be.
Yeah, widely perceived to be. And I think the misconception is account of the fact that you look at only the metros where there is a slightly higher entertainment tax and so on and so forth. Regional cinema is generally non-taxable, and so and there are several reasons for it.
True. So essentially change required on telecom and a slight misconception on the cinema halls front.
Yeah, I think there is a clear need for telecom to kind of go down to 12, and even for cinema actually to go down to 5 and 12.
All right, point taken, Uday. So clear need for the government to relook at the tax rate concerning telecom, and perhaps if it's in a generous mood, also cinema. We now have our next caller, Praveen Chikodi from Belgaum. Praveen, go ahead. What's your query for our expert tax panel?
My question is that when the supply is done with a free quantity or bonus quantity. Hello?
Yes, Praveen, go ahead. We can hear you clearly.
Yeah. So when the supply is done with the saleable quantity and free quantity, where the free quantity is not charged, GST would be applicable on free quantity?
So, all right, Praveen, we have taken a note of your question. Dr. Shrikant, would you like to address Praveen's query?
Yes, in fact, there is a very clear the provision clearly specifies that anything which is supplied without consideration will also be liable to tax. So, apparently, government is not in a mood to really forego the opportunity to tax any supplies, which maybe between businesses it could be for some reason that they would not want to have a consideration. But clearly one needs to pay tax, and the valuation has to be done as per the mechanism provided under GST law.
So it would fall under the purview. In fact,
so please.
Yeah.
Technically, if it is a free supply, and wherein it is not exactly a free supply because it is related to an additional quantity earlier given. So basically, in case of pharma, what would happen is that there would be some supplies which would be given as a bonus material, but it is related to the earlier kind of material. So there is a consideration applicable. Now, so conceptually, the law suggests that whatever is the transaction value that is charged, okay, that would be taken up. And in this case, given that it is not entirely free, okay, or even if it is kind of, if it is not charged in that particular consignment, one could still take a view. And
so does it fall under the ambit as Shrikant?
So to my mind, actually, no. Okay, to my mind, one could still take a view that that's a free supply that's happening and that's a transaction value. It's not to a related party. One may not charge tax. And also, in my view, one could also take a view that it should not be exempt supply. And that's what I think the industry is taking a view today also in the existing regime. That should continue. I think we are okay there.
All right, we've got a whole host of queries that have come in from our callers who are tuning in from all parts of India. But before we wind up the show, quick closing thoughts from both you gentlemen. 10 seconds each. The next GST meeting, the biggest priority of the government, starting with Uday.
So the biggest priority would be to two things. One is close out on the rules that are pending, and the rates, of course, that are pending. To my mind, there is a merit in looking at how the implementation will happen.
All right.
Give some bit of hint about what at least the initial phase of compliances will be depicted or kind of designated.
All right. What about you? Closing comments?
Yeah, I think more or less there is complete clarity on how it is going to be, how the GST landscape would be, and what are the procedural obligations and so on and so forth. So we need not expect too many surprises, but yes, there are a few issues, sector specific issues that have not yet been addressed fully to the expectations of the stakeholders. So somewhere clarity, especially for banking and financial services,
that needs to come in.
In fact, works contract services are I think, I don't know, but that is one of the, because infrastructure is one thing where these services are impacted, and we have them under a 18% tax bracket. So I feel that is where government really needs to seriously think before the next council meeting.
Sure. On that note, let me thank both Uday as well as Dr. Shrikant Kamat for taking out time and helping us analyze some of the ripple effects of the recent decisions taken by the GST Council. So clearly our panel is of the opinion that it's a gargantuan task that had to be undertaken by the government. A lot of clarity has been provided to the industry and to the consumer. Of course, there are a few nitty-gritties that the panel expects that the government will take care of when the GST Council meets next. Thank you so much for tuning in. This is Ashwin Mohan signing off. Stay tuned to ET Now for more news and updates.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.